welcome to the webinar where we take a closer look at the tools behind our 3-point playbook portfolio. A portfolio that in 2025 hit an upside of 34.48%. Liam Flavelle, the guy next to me, he's the guy with the answers to all the questions, and I'm going to pose all the questions that I have. But you're welcome as well to give us a little email. If you write to us at FOMO@MyStockScanner.com, we might be able to get your questions in. But we have a lot of things to go over. Liam Flavelle, first of all, ready for the show? Ready for some action here?
Definitely. I've been drinking heavily for 3 hours, so I'm all fired up and ready to go.
I see that's the timing after Trump did his speech, and that's when you
Yeah,
started drinking, probably.
you
But
needed something to get through that, didn't you?
true. Hans Henrik Nielsen and you started MyStockScanner, and you built the 3-point playbook. Tell us a little bit how it came about. I know Hans Henrik invested into stocks since 1987, but your background is fintech, isn't it?
Yeah, so I've run, built, and sold off a number of tech companies over my time, and yeah, I've always been in the financial side of things. I've been in UBS, I've been in Swiss Life, I've been in Aon and insurance industry, and then I ran my own companies as well. So that's my background as a techie and a business owner. The MyStockScanner came first actually before the playbook. That was basically, we were looking at all the tools that Hans and I always used to invest with, and we were saying, if all of these were just in one place, wouldn't it be brilliant? And then we came to thinking, we might as well just build it then, because there's nothing else like it. The playbook came up afterwards because we started trying to get a pattern in what we do. I'm more of a systematic programmer, so an algorithmic based one, and I've come into the technical analysis and the fundamentals after that. He's the other way, coming towards the more systematic way of things, and we came up with a set of rules. That's what we did.
And those rules we apply to each and every stock that we do. And that's it's gonna be simple, believe it or not, because
Yeah.
there's a reason why it's called 3-point playbook. The thing is that we really want to ask each stock, is it a quality stock? Does it have an upside? And is now the right time to buy? If you got a yes on all three, well, then you're able to see if you should put your money into it. And you guys, both Hans Henrik and you, are seasoned investors. But right now, with this playbook, you can make everybody take a look at a stock, and within 30 seconds, once they have the hang of it, they can see if they need to invest or not. Isn't that true?
Yeah, and that's what we aim for. The system helps you do that. You don't need the system. We aim to educate you. That's the biggest thing. We aim to get you into the position where you can make your own decisions. What we show you is the key areas that you need to look at in a company that will actually tell you whether the company is a good quality stock and whether there's upside or not.
We're going to take you into the playbook itself now, but first we're going to take you to the platform. And the platform, it looks overwhelming the first time you log in, because you're going to go, I can never ever get the hang of it. But trust us, you can. It's simple. I can figure it out. So that's how simple it is. And we're going to use some various stocks that we're going to show. And the first one, I'm going to give it a little intro, because Liam, you always call this the most important stock in the world.
Yep.
It's TSMC. That's what they call it over at their own longitudes, and in Taiwan Semiconductor. That's what we're talking about here. We just call it TSM. And you went straight into it. Can I get you to step back and just start over in that sense, so we
Of
get
course you can.
sort of the front page that people log on to and where they start on their web page?
Shift that one out of the way. Yeah,
Yeah.
when you start on the homepage, it's you come straight into a list of articles. So one of the key things that we do from a platform point of view, or from MyStockScanner, is we provide education. Some of that education is in, yeah, what's a PE ratio, and what does return on capital mean, and things like that. If we take a step back, the first thing we always look at in the morning, when you look at the market scan, is Hans Henrik takes an overview of what's happened from a macroeconomic point of view in the market. And why is that important? It's so that we can start spotting headwinds and tailwinds that are going to drive certain stocks in a certain direction. So we had that with memory stocks. We picked up in December and before that there was a big tailwind coming for memory stocks, because there just wasn't enough capacity because of the AI boom. We spotted that early. We managed to get into one stock on there in particular, and it's up. I think it's up today 7%, 7 or 8%. It's probably up 46% in 24 days. So that's the benefit of having this macro overview of what's going on. You guys, as you get into the system, get into the macro stuff as well, because we make it more accessible for you. We sort of point out what's going wrong, what's going right, and where some of the pain points are in the global economy. We had a comment on Facebook the other day from one of our subscribers saying, "What have you done to me? I've just sat through the Federal Reserve interview after the meeting, and I've actually understood what's going on, and I've actually enjoyed it." So that's the sort of thing that goes on. But we do the heavy lifting in that and tell you what's going on, and so that's one of the things we offer from an educational point of view.
And even though
So
we're getting ahead of ourselves here in regards
yeah,
with the TSM, I want you to go to the 3 point playbook, just the overview of the 3 point playbook,
yeah, sure.
because 34.48%
Oh,
in
yep.
in a year. And there's a reason for it, and it's because we have a strategy. That's what we're going to learn you tonight, and we use it every single day. We are not falling in love with any stocks. We are not kissing with any stocks. We basically are robots. Hans Henrik says it's like watching paint dry.
Yeah, and you asked me a few weeks ago what sort of some of my favourite stocks just coming to the end of the year, and it was actually I picked some really boring ones. Mueller Industries. Yeah, we're actually still in it. It's probably getting towards the end of their run, but um, they are so boring it's untrue. But we've made something like 25-30% on them. So the more boring, the better. It means less volatility, and that's what we look at here. If you look at the chart, you can see this is our equity chart, the blue line here. This is the S&P 500 from a euro point of view. So it didn't do that well in euro currency terms last year, but our strategy just kept on going up. The really great thing, as well as the fact we made 35%, is this red line here. This is the drawdown. The maximum drawdown we saw was 7%. That means that our portfolio only lost 7% of its value at the worst time last April. For the rest of it, it's been around 2%, something like that. That means that we can go to bed, sleep well at night, and not really worry about too much, because the strategy takes us out of stocks when we shouldn't be in them. It
And
is
if
like autopilot.
It is. And if you scroll down just a little bit, there's another thing that we also sort of, do, is that we try to be invested in all different industry. But
Yeah.
again, it's not us deciding what industries we go into. It's the system that tells us where to go.
It's been a fascinating journey watching it, because we came up with the 3 point playbook, and we knew, I mean, it's not difficult. This stuff isn't rocket science. Who'd have thought of buying really good quality stocks when they're cheap, when they're just about to go up? I mean, it really isn't difficult to do. What we've done is we've quantified what were the rules behind how you can do that. But what's really interesting is seeing that grow and seeing how we shift in and out of sectors and industries as they start moving. And we've got a new tool that's coming up that actually tells us a bit more on that, and tells us as an early warning sign where those headwinds and tailwinds are coming in for the different sectors and groups of stocks. So that's going to be really, really interesting.
And even though that we are slowly, have been slowly been sent out of tech stocks and into industry stocks and healthcare
Yep.
and what have you, then we're going to start techie wise. It doesn't get any more techie, and now you can let it run. Taiwan Semiconductor, we can go into it and take a look at it at the 3 point playbook. It is a quality stock, even though that we're not in it anymore.
No, we're not. We made a really good profit out of it this year. I don't know if you recall what the profit was actually, but it was something like 80%, 70%, something like
Yeah,
that.
you're not
Um,
wrong.
when you want to search for things, all you do is you hit the search button and then search for, I don't know, Novo Nordisk, and it will come up. We've got 70,000 stocks in there. So this is how you get to these stocks, and you just click on the one that you're interested in, and it will take you to the page. I searched earlier on for Taiwan Semiconductor. It gives you a short company description, but the key thing is where it takes you initially is our playbook dashboard. And that gives you a 30-second overview, as Jesper was saying. So literally, when we're teaching people, when we're showing people how to use these things, I say to people, I can probably tell within 10 seconds whether a stock is undervalued and whether it's high quality just by looking at the key three metrics on the dashboard. There are more that we drill down to, but to really just have a very quick overview, I look at our quality score. 98 out of 100. It's no surprise. I mean, TSM is, the chip manufacturer in the world that, they do everything for everyone in every country. So that's the quality score is really, really high. Earnings per share. This shows the historics, 21, 22, up to 25, and then the estimates from the analysts going forward. So these are earnings per share. This is how much per share they have in profit, basically allocated to each shareholder. Potentially they can either reinvest that, or they can give it back to shareholders, and a whole number of things, buy back their shares. And the third item is the peg ratio, and that is shows us how much the growth is actually locked into the price already. So a high peg ratio means that actually there's not much room for growth in there. A peg ratio below 2.5, which is where the green line here starts, as the line starts becoming green, that means we're starting to get interested, and the lower the better. So literally, I can look at these three items in the dashboard and think, actually, I'm going to spend some more time on this stock, or no, that is a complete mess. I'm not going to go anywhere near it.
And one thing that we have done also to enhance this experience, so to say, we work with colors. Basically,
Yes.
the more green you see, the better it is.
Exactly, exactly. So there is a little bit of red on TSM, but not an awful lot. So here we can see, so going through some of the others, we've got the revenues, which are going up in the right direction as well. You've got a health score. We might be taking that off. It's a fairly old, it's called the Petrovsky F score, which was designed by Joseph Petrovsky back in 99, something like that. It's sort of probably a bit old in tooth now. We've got the analyst recommendations, where you got 4.6 out of 5 analysts believe that this stock is going to go up. You've got the analyst changes over the last 90, 30, and 7 days. We like to see those in positive, because it means the analysts are starting to spot a trend swing in there. So individually, the analysts may not be massively accurate. As a herd, I think that's a herd of analysts is the group name for them. They tend to, we tend to say that they've got all the information. They do the interviews with the companies. They go and visit the companies, so they have a lot of information with which to base their statistics on. So as a herd, we tend to look at those numbers, and you'll see more when we start valuing the stock. Then we've got the returns. You've got return on capital employed, you've got the return on equity, and you've got the return on invested capital. They're basically, we won't go into them in too much depth now, but they basically show us, for every dollar of cash that gets inputted into the business, how effectively and how efficiently the company turns that into profit for us. That's the bottom line. And there are various different metrics. Some are better for industrial, some are better for financials. Warren Buffett always says he doesn't want to invest in a company that's got an ROE, a return on equity, of less than 40%. So we
And one thing I want to say here, because I'm fairly new at this still, and the thing is that don't worry that you don't understand all
yeah,
the words. We have a little learning section. We have loads of videos and how to and explainers that you can find in our learning section, including a dictionary of all these
yeah,
words that you're mentioning right now that
yeah.
might sound like a mumbo jumble, but look for green. That's what I'm always
Look
saying.
for green is the key thing. But one of the things we are doing, we're beefing up the help text on here, and the help system generally across the platform, to make it a lot more accessible, so that you can just very quickly say, "Oh, I can't remember what return on equity means. What is it?" So we've got those. Then we've got another two of the same pieces of information, but just shown in different ways. You got free cash flow and price to free cash flow. Free cash flow per share is effectively the amount of cash the company generates, which is different from earnings because of accounting terms. Basically, my wife's an accountant, so I quite freely say this: they will rip as much money out of you as possible, and they'll fiddle the numbers. And I'm joking, but there are various different ways of presenting the information. But one of the things that's very difficult to fudge, or to to hide, is the amount of cash coming out of the business, because that's basically what you've got in your bank at the end of the period you're measuring for. So we tend to look at cash flow as much as earnings, because it can be quite an important metric, and it can, it can't hide too many sort of errors in there. So the free cash flow, and the company generating massive truckloads of free cash flow, is an excellent thing to look at. Then we've got the price to free cash flow, which is literally price divided by free cash flow per share. That gives us a metric that we can compare against other stocks, and we generally say that we want to see this below 45. That's the area where the stock starts getting a little bit cheaper, compared to the amount of cash it's generating. And then finally, we got the current ratio and we've got interest coverage, which is blank here. We'll come to that on another stock because at the moment they just haven't got any necessary debt to offset against this. But these two metrics cover debt to tell us how indebted is the company, how how bad is it, how badly or how easily can they pay off their debt. Current ratio more than 2, more than 1.5 is pretty good. More than 2.5 is getting on to very, very good. So
To me, it sounds like the first step of the 3 point playbook is a big fat green
yeah,
yes.
yeah, the more green the better. And the key ones, to be honest, these ones are non-negotiable. Maybe quality score sometimes, if we think something like Intel, I'm starting to warm on a little bit more. It's got a very low quality score because it has been a business that's been abysmally run for the last 20 years. But they have an opportunity now. So that's something that we could potentially ignore a low quality score, but the other metrics got to be really good to do. But yeah, the more green, the better. And these are the 3 key ones that I look at. If we go down to the value chart, so everything is very neatly within the playbook page, but I'll just open out the value chart a little bit more because this is the editing page. It allows us to move things around a little bit better. So here we can see we're looking at earnings now, and we're saying, okay, the analysts, last year Taiwan Semiconductors produced 334 Taiwanese dollars per share of profit. And this year, the analyst thing is going to be 453, and next year, 560, 570. So that's a 35% increase this year and a 25% increase next year. We're going with the same numbers. We're just saying, okay, the analysts, let's say the analysts know what they're talking about. You can tweak these and we can change them and we can put in our own numbers, but we're going to keep them the same and they'll always be updated as they get updated through the system. The thing we're going to change is what we think of as analyst appetite. And this is actually the PE ratio. And all it is the price divided by the earnings per share. And that gives us a multiple. So if we multiply 569, which is this terminal number here, by 31, and also by the exchange rate, because we're transferring this into US dollars, we get a figure of 557 up here. That's it. That's the magic. And that tells us whether a company is under or overvalued. So the analysts believe that the stock will be priced at $408 by the end of next year.
I'm just going to say here, because the thing is, we're doing this really slow on the first one. We're
Yep.
going to pick up speed, and we're coming to, at the end of the show, we have a stock that we are really close to putting into our portfolio. We think
Yeah.
it's a buy. It's not a recommendation to buy in any kind. It's just one that we really like at the moment because
It's
of the
one,
metrics around it.
yeah, and there's a lot of tailwinds behind it from an industrial point of view, from a macro point of view. There's also, it's just dipped below, so it's literally just gone out of our buy zone, but I believe it will come back fairly quickly. But so from here, the key thing here that we manipulate is this number, and this number is just a mathematical number. You multiply this together, but what it also shows you is it's what the investors are willing to take on as risk. And the way we decide what they are, we do it graphically. We don't do it just by plugging random numbers into the system. We basically look here. So this is the history, what the price should be at a PE of 19.93, which is my bear case, my worst case scenario. That's the red line here. So I've matched it to a lot of the bottoms going back. So it's sort of gone along there over the years. It's gone below there for 23. That was over COVID times. There's particular reasons for that. I know that because of my techie background, but this is some of the research that sometimes we do. But the worst case scenario I put is April, where the stock dropped something like 35%. We actually picked TSM up on, I think it was the 28th of April. So we had this run all the way up here, and I think we sold it around August time. But I'm counting that as if the bottom falls out of the AI industry. If everything goes wrong and we get massive problems in the tech industry, then that's where I think investors will start saying, this looks cheap. Let's start buying. And that's what you're effectively saying. And that's why we say the PE ratio is actually a risk measure for people, because at the moment the stock is trading at, if I just look here, it's trading at a current PE of 31. So all we're saying is that this stock will drop to a PE of 19. The earnings aren't going to drop. TSM have locked in their earnings for next year or two. So I don't believe they're necessarily going to have a drop in earnings here. So what we're going to do is we're going to see, well, investors may say, I'm not interested in paying that amount of money. My base case I set to 28. That's what I think is going to happen. And that I've just sort of matched to the drops over the last year where it's come down and then bounced back up. You can see it sort of there fairly obviously. And the bull case at 70%, I've literally just put the green arrow here. So I can move it around. I can move it up here if we want. But I've matched it to the peaks over the last year or so. So here we get, the system is telling us at the moment, in our worst case scenario, if we hold to the end of next year and the worst thing happens to us, we'll still be 10% up. In the best case, if TSM knock it out the park, they perform flawlessly, there are no issues, all their customers are happy, all their clients are happy, then great, there's a 73% upside. So
It
that's
looks, it definitely looks like it should be a buy, but right now I can see it hanging around the green one, the top one,
yeah.
and that's where we get a little worried. Are we paying too much?
And that's the thing. That's the whole problem here. Is what we call this area here is when the stock is priced to perfection. So it means that if it's hitting that level, there's less upside potentially in the stock. It will be more obvious in the next ones that we do very quickly, and we're taking a longer time over this one just to make it really obvious how these things are put together and how we actually marry up these numbers. But with this one, it looks like a no-brainer to come up here, but actually, if we waited to come down here, actually it could be a better buy. And that leads us on to the third question: do we buy now or not? Because at the moment we're saying yes, it's a high quality stock, tick. Yes, it's cheap compared to where it should be in the next couple of years. And then we move on to the next, which is now a good time to buy. There are three areas, and actually TSM ticks the boxes in these ones as well. Down here we've got what we call the MCI. They're our own homegrown momentum indicators. This one works on a weekly basis, so it's slightly slower, but it shows a stronger trend. This one is a daily one, which moves a little bit quicker. When they're red, like you said before, we don't really want to touch them. When they're green, then yes, we start being interested because it shows we're in a strong trend. So you can see here, the red matches with the swoons coming in, dropping down. It turns green again. It doesn't pick the bottom. No indicator does, but it gets up here. The other two areas that we look at is, from a technical point of view, is this green level here. Let's just zoom in a bit. This green line and this black line. The red line is I think it's a 20-day moving average. The green line is a 50-day moving average. And what you can see, the stock, when it's in an uptrend, bang, it tends to use the red or the green as a bouncing point, as a resistance point or a support point, and then goes up. Similarly, when it's below, it can use these lines as a resistance point, and it's when they break through that's when we start getting interested. So we look to see that the stock is above the 50 and the 200, and the MTIs are in green. And then sometimes we look for a bit of a retracement. So if we were coming in here, we'd look to see it bounce back down again and maybe come back up, and then we buy. And that's it. And the exit is the opposite of that. Literally, we exited, it was back in August. It dropped below its 50-day. It didn't look like it was doing anything else, and we sold. It was, in hindsight, the wrong decision, but we pocketed a 70% gain. You're mute.
That's the thing. We're always sort of, looking for the next metro or the next train that we can jump on. We don't necessarily stay on the train for a prolonged period. I think the average that we have stocks is between 30 and 50 days. That's basically it. And that's not a science that we're looking to do specifically, but it sends us in and out. The signals are clear, and that's one of the things that we used for the next stock that we're going to take a look at. The stock that every Dane has, they made money on it and everybody lost money on it. I don't think I'm too wrong when I say that, Liam. Novo Nordic, let's bring it up in the 3-point playbook because that's a different animal, so to say.
It certainly is. And it's one, obviously from a Danish point of view, it's very close to everyone's hearts, and also from a European point of view, largest company in Europe for quite a while, wasn't it? Let's go through this very quickly. So actually, you can see here when I say the three key metrics that I look at, they're slightly different. It's a high quality, it's one of the best quality companies out there. It's a stellar earnings and so on and so forth in the past. So 99 out of 100 is great. Moving on to the earnings per share, you can see the growth isn't quite there like it was with TSM. So it's peaking here and then dropping down. That's not a good sign. The one thing I hate, the only thing I hate more than that is dropping down here and then saying, "Oh, we promise we'll go up after that." That's where I really stay away from these stocks as well. But that's not great. I don't like that. And from a PEG ratio, it's above 2.5. So automatically, I'm looking at this thinking, actually, I'm really not too sure about this. I might have a bit more of a look, but because it's a quality score of 99. When we go down a little bit more, we can see the health score slightly less than TSM. The revenues are dipping down as well. You can see from the analyst estimate point of view. So this is this year and next year earnings. Analysts they haven't dropped too much, but they're fairly neutral on the stock at the moment. The returns are going down and they're going in the wrong direction, which means that they're getting less efficient, or they've got to pay more to actually produce what they're doing. So as the company they're in, the type of industry they're in, is very cash intensive. Free cash flow has been good. It's been going up while the good times were there, but it's sort of stalled in there. Price free cash flow is in the good zone, and the current ratio, sometimes with some industries, certainly more industrial industries, because they've got so many capital expenditures and so much capex on the books, that current ratio isn't a great indicator for us. So interest coverage is the one that I tend to use more than the current ratio here. Current ratio is just current assets divided by current liabilities on the balance sheet. So it just shows you a very quick understanding of, if the company had to liquidate everything very quickly, could it pay it off? But the interest coverage is a good one. It's got loads of cash. So mixed, and I'd probably already know that I probably wouldn't go near it at the moment. When we look at the value chart, different story slightly. You can see here, we were in it, we came out of it about here, I think, something like that, simply because that's what our strategy told us to do. And we didn't get back into it all the way down here, and we'll see why in just a second in the trading view chart. But you can see a couple of bounces here, so it's really arbitrary where I put my lines here, so I can move it down a bit, maybe to have that as a peak. That could go all the way up the top if you wanted, but I can't see Novo getting back to that level. Maybe down here is a good area to go to. So even with those figures, it is still undervalued. And one of the things we show people how to do is actually get a good risk reward. And from that, I mean, your base case should be twice what the loss might be in the bear case. So your worst case scenario, you're effectively saying, I've got 2-to-1 odds if I'm right at coming out of this with a profit, compared to coming out of it with a loss. So you're just loading the dice in your favor if you're into gambling.
One thing I know that you particularly don't like is that it doesn't grow. It doesn't
Yeah.
go up. It's not we're not talking about going vertical up, but we're
No.
talking a growth. Here, there's a little bit of a drop. We don't like that.
Yeah, I mean, the thing is, this comes down to the PE ratio. So, we say it's a metaphor for the amount of risk that a company or an investor is willing to take on. And we can see here on the averages, if I just shoot up the screen a little bit, we can see the historics. We can see the historic, the average for the last 20 years on Novo has been 24. The last 5 years has been 32. Surprise, surprise, because it's such a darling of the stock market. So it's been higher than it currently is, definitely. Oops, let's go to the right screen. But the other thing you look at is a PE of 20 means that you're actually going to pay the earnings per share that the company produces here, which is 22.8 krona. If they paid you that every year, it would take you 20 years to get your investment back. So, and with a company that's dropping in revenues and in earnings, it's going to take longer than that, because investors won't hang around for it. So that's why we always look for companies that are growing their revenues and definitely their earnings in there. Lastly, I mean, from a playbook perspective, the stock has just popped up. So it's green on the MTIs. It's just popping up above the 200-day, and it popped up above the 50-day. What we would look to do is see going up, bouncing off the 200, and then going back up again. And that's what would put it into our crosshairs to say, yeah, we're interested in buying this.
And one of the things that also the golden rule for us is that we're not going to buy it at the bottom. We never ever catch
No,
them at the bottom. We never go out at the entire peak. We want to see them prove that they're above the 200 and the 50.
yeah.
That it just got above, that's not enough. We'll see the bounce and then we'll go from there.
We
In
can
regard,
see that here. Just very quickly on here, you can see it's followed the 50 all the way down. It's poked above it, then failed, poked above it, failed, above, failed, and so on and so forth. So that's why we want to see that meaningful bounce coming down, using its support, and then like a trampoline bouncing back up again.
let's take a look at another stock that a lot of Danes were in for a long time, and basically all of Europe, because defense stocks got in favor at the beginning of the year. It stayed hot for a long time, went a little bit out of favor, and then now, due to a certain president visiting Davos right now, it seems like it has been back in favor. We are going to go German. We're going to go Rheinmetall, one of the biggest companies in that industry in Europe. And when I start seeing a screen like that you put up and I see those growing charts, I'm kind of going, yeah, okay, here we
Yeah,
go.
you start salivating, don't you? And
Yeah, a little bit.
Rheinmetall, we did a defence webinar, defence industry, defence sector webinar in February, and just after that, everything went mad. But we picked up Rheinmetall, Saab, Krones, and people like that. Rheinmetall was 176% gainer for us this year, all because we spotted it with the playbook. We got into it at the right time, and it came up. If we look at it very quickly, 87 quality score, fantastic. Earnings per share, very different story to Novo there. You can see it growing massively potentially. The continuing is just there are different elements, on how they account for these things. So sometimes it's a company sale or something like that that might give you some slightly different numbers. PEG ratio is below 2.5, is way below 2.5. So automatically I look at that and think, I almost don't need to see anything else. Yes, I'm interested. So everything else is green, the returns, etc., etc. Price free cash flow is a little steep there. Looks crazily steep, and it hasn't got a problem paying its debt. So yes, massive tick in the box with Rheinmetall. When we look at the numbers now on the value chart, is it undervalued? You've got to look at this and say yes, it is. I don't think we could argue. Yeah, the peak there was for the bull case was back here, so that's where I put my green arrow. You could drop it down there if you wanted to, but it's an arbitrary thing on here. The blue line, is where the stock is. We think it's probably going to end up. Maybe we'll just match it with these dips here, so that it's right in the middle between everyone. And the stock dipped at the worst case down here and then bounce. So I'm going to put my bear case there. So that could be the worst case scenario. We can go lower than that if we want and make it maybe more realistic. This isn't, there's not necessarily science behind this. What you're doing is you're trying to match it to what the real world is going to say. And what we see a lot of the time is people putting their bear case way too high. Up here, and that's sometimes wishful thinking. So you've really got to look at it and say, if I'm going to put my money in this, where is the most painful point that I would want to come out of it, and is that realistic? So that's what we do here. So I'll just match it with the bottom down here at the beginning of last year. So with that, we can see if we held to the end of this year, we're seeing a potential break even in the worst case scenario. In absolutely the best case scenario, we could double our money. In the more boring world, we'll just add 57% onto our profits. So it's and the analyst think is going to go up 15%. And so you might even want to lower it down a bit. But even then, it's still a really compelling case. And in TradingView, again, all green, all go. It's literally with the latest shenanigans from certain president over in the US, everything on defense has started going up. So you can see it was in the doldrums. We sold it somewhere around here. People say, no, it's going to carry on going up. But, in this case, the strategy was right. It was absolutely spot on. But it's just literally broken above its 200. It's broken above its 50. It's the green on the MTI. The other thing I really like here that I look for is something called a gap. So a gap is where there's a big difference between the closing price from yesterday and the opening price from today. That's always a great thing. It means investors are piling in there with just bucket loads of cash to get in there. Similarly, on the other direction, if you see a gap going the other way, it can be a bit of a warning sign for you. So that's just our testing that came out with.
And again, we're getting a little ahead of ourselves if here. And again, as I said, no worry about it. We do 5 shows a week in Danish at 12 o'clock. We do 2 shows in English at 1 o'clock Tuesdays and Thursdays. We go over this over and over again. It's the same each and every day. And that's just how we do it. It's simply repeating the strategy on each and every stock we take a look at. And let's change scenario, because right now we talk about defense being a hot stock, something that's been easily even hotter than defense stocks lately is of course any precious metal. We were in Barrick Gold. We also went out, probably not the right decision, but then we jumped into another metro, another mining stock. Take us through Barrick. It's the ticker code B, and let's
Yep.
see what it's if it's A to B to C or whatever it is.
Definitely. The one thing I'd just say on that is it wasn't the wrong decision. Our strategy is tried and tested. Sometimes with hindsight, you can look at it and say it carried on going up. Yeah, absolutely fine. But what it allowed us to do was take that cash and put it somewhere else and put it to good use as well. So it's always an interesting one where you look in hindsight and think, oh, we should have done that. Barrick Gold, I mean, people who have been actually, who haven't managed to put to sleep yet, will have seen here, quality score 94. EPS going up, the golden bars are fantastic, and a PEG ratio of 0.28. That's the best we've seen so far. So automatically, everyone probably should have been looking at it thinking, "Oh, that's nice, isn't it?" And I'm exactly the same. Analysts love it. They've upped it by 12% in the last 90 days or so. The returns are fantastic. And certainly hasn't got a problem with interest coverage, and even the price free cash flow is in the green zone, so it's a good potential buy. We have 2 other gold stocks in the 3-point playbook portfolio at the moment. They're going great guns. I mean, they've been up 10% in the last couple of days because of a certain US president shenanigans. From a value chart point of view, as usual, you can see I really obviously, the chart is quite nice to us. Some of these stocks are quite nice to us. They give us that bottom that we can just match our bear case to, because that's the lowest point for the last ever, that the stock has been down and traded down at this level. So I can quite happily say that's the worst it's probably going to get in real terms. Obviously, it could go to zero if the whole company failed, but you'd hope not. The other thing with gold stocks, ironically, because gold is traded in dollars, the dollar dropping is actually a good thing for the gold side of things. So it's a bit odd, that one. But then the bull case again, we just matched it up to where it is at the moment. It's peaking. It's massively peaking because of inflation concerns, and it's a flight to safety for people. So we see potentially over the next 12 months or 11 months, 47% upside and maybe a 20% downside. And actually, I put my base case here, which I think is going to happen just where those sort of communal areas are, where it's peaked, come down a bit, gone back through. We haven't got too much in the way of evidence to say where it would go. You could actually put it down to here if you wanted to. So Barrick Gold for us is price to perfection. We can see potential going up, but actually this 20% loss potentially in the worst case compared to just the 10% that we think is going to happen will be enough to say we can probably make safer money somewhere else. We can tilt the odds into our favor with another stock like Rheinmetall, for instance.
So that's also a decision that we take, is that when you say price to perfection, people tend to go, oh, perfection, that's good, that's what I'm aiming for, but not so
Yeah.
fast, because that's simply not where you want to be. Because
No,
again,
we want cheap.
we want cheap, we don't want perfection. That's how it
Yeah.
is. And again, one of the things that we stress over and over again, we are not a stock. It could be that your dentist or your hairdresser, whatever, say, oh, everybody's buying gold. Doesn't mean that we fall in love with them and then stay married to them. We just look at the numbers. That's it.
No,
And if the numbers are not right,
now you're just being nasty, though, aren't you? Because you know that A, I went to the dentist today, and B, I haven't got any hair. So you mentioned the 2 people in my life at the moment that actually, just cause me pain.
I will say that was surely a coincidence, just like the numbers. But it was no coincidence, Liam, that we never ever went into the Danish stock called Shape Robotics. And I know that people lost money on it because it went bankrupt. I had a little bit of skin in the game as well because I thought robotics was the future. So I put in just a little bit in that and I burnt my fingers. But if I've been playing by the 3-point playbook, I would never have been in it.
No, no. The technical term that we use for Shape Robotics when you look at the playbook dashboard is a shit show. It's it's a technical term, but
Yeah, I
we've got a
understand.
quality we've got a quality score of 37. We've got earnings per share, which are losses, and the estimates, the analysts aren't estimating it making any money in the future. You've got a health score down at 3. It's not doing too badly now compared to before, changing its money into something else, whatever. Whether they're nearly at a profitable stage, it sounds like, but they've obviously gone out of business now. But this is why we go for the quality stocks. So you can see here, the numbers was gradually getting worse, but the free cash flow, that's the area that, again, that would be a massive warning sign for us. I said earlier on, you can't hide from from the cash that's being generated for the company, because it's either in your bank account or it isn't, and you could see it steadily getting worse as it went through. And current ratio wasn't too bad, and it's saying it hasn't got a debt problem. So yeah, we wouldn't have been in it at all. And also, when you look at the value chart, you're thinking, well, where are all the pretty lines? We haven't got any pretty lines because actually there's no history to go on. The company made a slight profit 2 years ago, and that's it. So we have no idea how to price this because we don't know how investors have previously priced it. So we wouldn't go into it. And then finally, from a chart point of view, people will be able to spot it now. If we're just using our trend indicator here, we've got the NTI did flag up green a few times, but on the uptrend, but we would have been out of it somewhere around here, and then just watched it dip going down. So our 3-point playbook, our 0.3 would have kept us out of trouble for the last 2 years.
And the thing is that what we're looking for are, as we always say, freight trains. We're looking at trains that just chuck along, make money, grow, grow, grow. And we don't want somebody makes money the one year and lose money the next and stuff like that. We don't like that. That's simply
Yeah.
not how
No.
we operate.
No.
We promised at the beginning of our little webinar that we would show a stock that we talked about this week on your usual Tuesday tech. Every Tuesday and Thursday when Liam is doing his show at 1 o'clock in the afternoon, we always talk tech because that's your background. And one you flagged this week was Amazon. You really like Amazon. Explain why by the 3-point playbook.
Yeah, everyone's heard of Amazon. What they don't realize a lot of the time, they think of it as a shopping company. It's not. The biggest part of the business is something called AWS, Amazon Web Services, and they're the largest cloud provider of cloud compute in the world. They're closely followed by Microsoft and then Google and various others out there. Amazon 3-point playbook, quality score 99, earnings per share going up, PEG ratio 1.17. Everything else in the green. Free cash flow was a little bit red, and then it sort of stayed pretty much level, which is why it doesn't really like it. Price free cash flow is a little bit over the top, but everything else is fantastic. So big tick in the box. Yes, it's a great company. From a performance last year, it was actually the worst performer of the Magnificent Seven, which are the 7 big tech stocks that people talk about. So last year it was a bit of a laggard, but that gives it an opportunity. It's doing something that we haven't seen yet in our demonstrations on the platform, and it's following one of these lines very, very closely. And that's a great sign, because that means that we're thinking, well, that blue line is pretty predictive of where it's going to be and where investors have stayed for the last 6 months, even though there's massive turbulence in the industry. So if it carries on going, it's going to be up 42% at the end of next year. At the worst case scenario, I've just put it to the April dip. So that's a potential 25% up. And I've just matched the green line here with the top of the peak last year. So that's a potential 73%. What I've done is I've actually added in another year here, because we've only got sort of the next 2 years of forecasting there. If I just drop that down, everything changes, and you can see that just comes up to a 42% potential gain this year, 17%. And is what we think is going to happen if it carries on the blue line, and the worst case scenario of 2.3%. So from a risk reward point of view, we're risking 2.3% in our opinion, and we're going for a potential gain of 17% plus. That's a fantastic risk reward. From a trading viewpoint of view, the stock sort of dipped below its 50-day yesterday. and it's dipped a little bit more today. So we would wait and see whether this bounces back. And we say bounces off the 50-day moving average. It can drop down and then come back up again. The 50-day isn't like a trampoline where it's a physical thing. It can drop slightly below and overshoot and then come back up again. And that's generally enough for us to say, okay, that's now acting as a support and it shouldn't go below there. If it does go below there, we sell. We sold 3 stocks this week, didn't we? I think, because we bought them, they dropped below their support levels meaningfully, and they stayed there. They don't look like they're dropping back up or coming back up again, so we exited.
And that's one of the most important things to learn, is to stick with your strategy, and that you have the rules that you have, stick with them each and every day. Don't that you can predict that it's gonna bounce, if for it. It might bounce because of all things that you can't control anyhow, and then you can always get back in. And instead of losing a lot of money where it keeps dropping towards the 200-day moving average, then get out, sit on the sideline, go back in again.
That's exactly it. And I'll just finish by showing some of our stats here on our 3-point playbook portfolio. So this is something that premium subscribers, they get access to this. So we put our trades into here and say, use this for an education. See how we do it. Either take some of them, look at them, analyze them yourself, and then decide whether you want to buy or sell, or just take them for inspiration and look for other stocks like this. And some of the great things is people out there, some of our clients do better than us, because they take our ideas and they go out and find other stocks. Some of them take more risk and so on, so they do slightly better. We're quite happy with what how we achieved this, and we achieved this because our average winner is 22% gain. Our average loser is a 6% loss. That's cutting your winners early, and that's letting your winners grow. We only have just above a 50-50 win rate, but those two numbers there mean that actually we get a 34.8% profit last year.
And the thing is that we never ever invest more than 2.5 towards 3.5 or 3.2% of our cash, the money that we have, go into a stock, which means, let's just, for instance, take the mathematical thing that you have a stock that you own 2.5% of, and it drops 10%. What have you lost in a day?
Yeah, somewhere around just under 0.25% maybe.
Exactly. And that's why we are diversified in also how many stocks we have in our portfolio. We basically never ever put all our money on red, because that's not how we operate.
Not at all.
Sorry.
I was just going to say, we dropped down here today. We're down to 80% invested. We were up about 90% or something about a week ago, but the strategy's taken us out of a few. We now have 13% of cash to actually allocate when the market starts coming back up.
And we're just waiting. We are in no rush. Last year, as said, over the full year, it just kept growing all the year long. We had some bigger winners in the spring, but all the year long, it just crept up, and we ended at 34.48% of the return of our capital invested. See, it's no rocket science, and we want you to be part of, I'm just going to say, the rockets, not because it's going to be that exciting, because it's basically like watching paint dry when we do things. It's the same thing over and over again, and we do it every day. And we also do a show each and every day at noon. Today the show was about United Airlines, American Airlines. We talked a little bit about defense stocks, because the Danish defense minister went to the UK, had a meeting over there, which meant that we talked about Babcock. Of course, the US president came to Davos in Switzerland, so we had a little talk about what he was going to do down there, what he was going to say, and most of you probably followed it on the news. And then we looked at Netflix that came with earnings. We do 25 minutes show each and every day where we analyze all the stocks, and on Tuesdays and Thursdays, Liam Flavelle is with us and does the show in English. That's 1 o'clock. Apart from that, we create a lot of content on our page, MyStockScanner.com. We also basically share some of it on our social media, which means Facebook, that will go out and share a lot of things, so you can see what we're doing. And we always take questions. You can always write us at FOMO@MyStockScanner.com if you have any questions. And again, it looks complicated. Liam, if I can figure it out, then everybody can. Isn't that the way we say it?
Definitely.
It is.
I can't say any stronger than that. It's Jesper can do it literally. I mean, my Labrador, I think, could probably do it as well.
Yeah, probably do better. And even Hans Henrik has a cat that predicts the stock prices
She's the
as well, so I'm
CEO.
outcompeted. But listen, it's all about quality, it's all about upside, and it's all about timing. That's the three legs in the 3-point playbook. Take us for a spin, take a trial membership. You can look into our under our hood and see what we have invested in. Do it at mystockscanner.com. It's a month free, and then decide if we're worth taking for a spin. Liam Flavelle, pleasure having you with
Thank you
us
very much.
this evening. We'll do it again in a
Yep.
month's time. Then we do another show and another webinar. You guys, thank you for watching. We'll see you around.